Good morning, folks. I hope you've had a great week. There's been good news flow also during the week, and most of it pretty positive. So let's dive into it. I will be covering 8 topics today, quite a handful, starting with what's happening on the tariff talks, and then we go on to views from 2 senior fund managers, one foreigner and one Indian. Then we look at real estate investment trusts. There's some interesting research on profitability of companies across the world. Okay? And we'll see where India stacks up in that list. And then one of my favorite subjects, how momentum funds are doing. And then, of course, it's been a very critical week for most of the world with the Fed announcing its interest rate policy. We look at that impact. Then there's been a large article on retirement, how 50-year-olds are looking at retirement. I thought there were some interesting takeaways there. We'll come to that. And then, of course, there were 2 different views on how retail investors should be participating. This is what I have for you this week. So let's get into it. So it all started with the US President Trump calling to personally wish our Prime Minister Modi ji for his 75th birthday. And that made the headlines. And Modi also responded in good nature. So the fact that the US President took the effort of calling him up and speaking personally, the ice was broken. The barrier was broken as to who would speak and who would not speak. And that brought about a whole lot of optimism that the talks would get back on track. And on track they did get. Okay, so one of the negotiators came down from the US, spent some time with the Indian team, and quite happy, I guess. And of course, it doesn't mean everything is smooth, but at least we've got back to talking, which is most important. Of course, all kinds of optimistic stuff coming out that the penal tariffs will be removed. Eventually, we'll end up with 10 to 15% tariffs. I don't know what would happen eventually, because every now and then, I'm sure the other party is going to pull out some ace from their sleeve and threaten us with greater tariffs or greater restrictions or sanctions or whatever it be. Okay, and there was an unusual comment from Trump in the presence of the UK Prime Minister when on his visit to UK yesterday, and he said, even though Modi is such a great friend of mine, we went ahead and imposed tariffs on India because they have been buying oil from Russia. He seemed to say that Europe is also buying a lot of oil and gas from Russia, and while we are imposing sanctions on India, why should Europe get away? It's not fair on America, he said. So it seemed a very ominous statement. It was during the press conference, and sort of I thought it stuck out. Let's see what happens and how it goes. But markets in India responded well to these talks coming back on track. And while the Nifty as a whole just ended up marginally above at 0.17% from the beginning of the week, the IT index heaved a sigh of relief and was up by more than 1% during the week. Because these guys, as we all know, were pretty worried as to what would happen to IT services in the entire process. And while there was nothing on the table, there was always the threat that there could be an impact on outsourced services also. Let's hope it doesn't happen. The IT stocks were happy. So let's look at what's happening with the views of some of the senior fund managers. So there's a very dramatic headline here. It's time to take exposure to Indian equities, says Chris Wood. Chris Wood is the one of the most well-known FII managers, at least in Asia. Okay, and he's popular for the blog that he writes regularly called Greed and Fear, which looks at both the elements of market drivers. Okay, and what does he say? He says that Europe has done well, led by domestic stocks such as banks and defense, but not exporters. And we know that too, right? We've been talking about Europe defense funds in the past. Japan continues to perform on the back of corporate governance reforms. And we're going to come back a little more and see on when we talk about the profitability of companies across the world. Okay? And he was overweight in China, and China has surprised positively, doing very well over the last year. But he goes on to say that if I had just two portfolios, I would reduce my overweight on China and begin to go overweight more on India than he is presently. So it just signifies that probably China has had a good run and India has not. We all know that FIIs have heavily withdrawn from India, and so the view of an FII manager like Chris Wood saying that it's time to get back to India makes some sense. All this, if you see in the backdrop, there's some momentum on talks between US and India, adds positivity to the entire thing. So he says that it's a good time because the markets are sort of consolidated. We've had the market going sideways for quite a few months now, while earnings have gone up a bit. So it probably thinks it's a good time to get back into Indian equities. So there's a question, by when do you see the markets break out of this consolidation phase? And he says, I think the fourth quarter of 2025 or early next year is when we may see a pickup in the Indian stock markets, partly due to GST related measures. So he feels that by then there would be a pickup in demand. All the moves from by the center would have some fruits evident by then. And hence he thinks that tariffs also probably gets resolved by then. So a breakout in the Indian stock market could happen by then. Okay. So he also thinks that corporate earnings, he says corporate earnings, very diplomatically, earnings have been coming through, but slowly in low single digits, which has been our worry, right? That top line is not growing enough, demand is not enough to take corporate earnings to the next leg out of this low growth. Okay, so he thinks that earnings growth of 12 to 15% for next year is what would be realistic. And though 12% is more realistic, he says, let's keep note of that. And we all know that stock markets are a slave of earnings. So if you think earnings growth is going to be 12% and markets are not way overvalued, then the market also would give a similar rate of return broadly. So if you're thinking, what is the market going to give me? This is probably a peg at what you can think if nothing else happens in between. Okay? He also says that nominal growth has to pick up. We know that nominal growth came in very low in the last quarters, below 9%, right? 8.8. It says it should go up, from 9% to around 10% in the next 12 months. That would mean some real improvement. Okay. I mean, it's a paradox of sorts. I'm saying nominal growth and real improvement, but yes, we need nominal price growth to help corporate top lines. Okay, if it doesn't happen, he says there's something structurally wrong. Okay, that I hope it doesn't happen. And his base case for returns from the Indian markets is 10 to 15%, though stock selection will matter more than the index. Okay. So when you have markets running up, there's a homogeneous rally, then index is good enough. But he, like many other experts and even our house view, is that stock selection is going to be more important in a market which is going sideways, and subsequently you'll have selective sectors improving rather than all of it going up. So stock selection, actively managed funds should probably do better in this kind of a market. Though he thinks that IT services should not be given as much importance, he would like to avoid because of the disruption risks from artificial intelligence. Okay, so that is one thing. His message to Indian investors, he says, this is a healthy consolidation phase. Bottom-up stock picking is crucial. Conservative investors should consider some allocation to government bonds. Overall, patience will be rewarded. So it's not often that you hear of an equity manager saying, have some money in government bonds. It's because government bond yields are looking pretty good. We'll come to that. Almost 6.5% today on a 10-year gilt, and corporate bonds a little higher than that. So around 7% on a high-grade corporate bond. And given that earnings growth is low, stock market returns for the risk is not really up there. Good to have and not to ignore fixed income opportunities. Okay, so let's go next. So there was an announcement saying that a REIT will be classified as equity from now on and not as a hybrid security. So that gave a massive boost, and there's a whole lot of buying in REITs because they could be more popular. But that's strange. One should not expect such knee-jerk reaction in a hybrid instrument, which is largely driven by income growth and not capital growth. Okay, why do I say that? All the REITs that we have today, the underlying are tenanted properties, large tenanted office properties or retail properties. So the earnings for the REIT is a rental income. So rental income is rather steady. We don't expect spikes there. And we need to take closer look at the yield that we get out. You know that 85% of a REIT's income has to be distributed as per SEBI guidelines. So all the rental income, 85% of it gets distributed. And what some of the analysts are saying, on a 12-month rolling basis, we expect REITs under our coverage to give 6 to 6.5% distribution yield, which is similar to previous years. For an instrument which is going to give you a 6 to 6.5% yield, sharp spikes in prices are just not on, unless they were dramatically undervalued earlier. So I expect maybe the reaction was a bit too much. We should wait for yields to be looking good to buy back. Okay, and it also says that there are risks in these REITs because most of them have large tech parks as the underlying, and we are not seeing too much demand on tech parks going forward because of the disruptions. So the chairman of Anarog Group, one of the largest property brokers, says near-term risks stem largely from tariff uncertainties and prolonged global geopolitical tensions, which could lengthen the decision-making cycles of large corporates, particularly those headquartered in US. So one should be a little mindful of this, though these are great alternative investments. These are great income-bearing investments for in general to have in a portfolio. So now we come to that bit of research where the profitability profiles of companies across the world. Very interesting bit of research, largely I guess led by Yes Securities. So they've looked at India, US, Western Europe, China, and Japan, and seen what has been the trend of loss-making companies, that is the inverse of profit-making companies. Okay. And we find that India and Japan are looking very, very good in this comparison across regions of listed companies. So in India, it's only 8.2% of companies that are loss-making now. Okay, so this is a dramatic turnaround from a few years back when almost 17% of companies were loss-making, and now we come down to only 8.2% companies that are loss-making. Giving us companies, Japan. In Japan, it's only 6.5% of companies that are loss-making, as compared to again a similar 15% a few years ago. So in Japan, there has been a resurgence of corporate governance based reforms, and again driven by the Japanese government. And India also looking very good. So how are the other regions looking? US, Western Europe, and China. Results are pretty shocking actually. In the US, 35.2% of companies are loss making. In Western Europe, it is 18.4% of companies, and China, 25% of companies are loss making. And the trend in China is a sharp rise up. It's not it's not a squiggly line, but it's a straight line up, which we should be concerned about. Statements made by President Xi in the last week on how competitiveness should be addressed in China is very important. So he says Chinese companies should stop the race to the bottom, because there was so much production, so much competition, margins were being undercut, prices undercut in this competition. It was bad. So a number of Chinese producers actually are running on razor thin margins or slipping into losses. And even if there's a slight impact on demand, it could have a magnified impact on the Chinese producer. And the last week's papers also have been filled with photographs of warehouses and yards in China filled with cars. There are thousands and thousands of cars unsold. The large inventory of traditional petrol engines and also electric vehicles, new cars which are not getting sold, and now they are getting sold through resellers at a 50 to 60% discount. That says a lot. So even recently when we were talking to Prasenjit Basu at the strategic event, he said that the Chinese financial ecosystem is a minefield. The losses could be enormous if they are booked. So we have to be careful. Waters run deep. You never know what's happening bottom. But I think what the Chinese government is saying, the Chinese premier is saying that they should stop competition in a manner which takes them into losses and undercutting. It's a good sign. Let's see what happens. America 35% as a result of all this, not great. Okay, and Western Europe also at 18.5%, though it has come down from 27%. In India, the turnaround has been led by a number of the heavy industries. Okay, the oil, gas, the metals and mining, and capital goods companies. That is where there's been a good turnaround from loss making to profit making sectors. So yes, if you're anywhere else but India and you want to invest somewhere in the world, remember Indian companies are looking good as compared to the rest of the world. Okay. And somebody has done some work here. Says momentum funds outpace others. Will Stellar run last? I hate these kind of headlines where it says, will the Stellar run last? Okay, they're like clickbait and they're just getting it. But then, yeah, factor-based investment strategies are my favorite. So I love to dive into these kind of articles and see what they have to say. And yes, it just reiterates what we have been saying and using in our strategies, that momentum based funds, momentum factor funds are great for the long term. Okay, if they have the right algo. So rather than an actively managed momentum fund, even if I do look at the passively managed momentum indices by NSE, either the momentum 200 or here the BSE 500 momentum 50 that is used in this analysis here, over the long term they do tend to outperform. They do add anywhere between 4 to 5% in terms of alpha. And here he says that the momentum, the BSE 500 momentum 50 gave 34% CAGR returns in the last 5 years since 2020. So how does one get such a high number? One should remember this is the BSE 500 index, which includes mid cap and small cap stocks. And since the mid and small had a stellar run over the last 3 years, you can very well infer that much of this performance is because of the size factor. So within the momentum performance, we can further break it down and say the size factor was responsible for this. But yes, in measured doses, it's acceptable and even good if you are aggressive enough to have momentum factor funds in your portfolio. But one should be patient, because when markets fall, these guys tend to fall more, and but they do make up when the markets go up with adequately higher returns than the market. Okay, so he also goes on to say that momentum outperformed value and quality substantially. Okay, so there's a quotation there that looking at a 20-year history from 2005 to 2025 and doing a rolling comparison of returns rather than a point to point one, momentum has generated a 7.88% alpha over the Nifty 50 index on a 5-year rolling basis. That's huge. Okay, quality has generated a 4% alpha and value a 2.43% alpha over the same period. Okay, what I would have preferred that they include is low volatility, because at least we think that low vol is one amazing factor to have in your portfolio, especially in some time. So it balances very well that we have some momentum and combine it with some low vol. Okay. Then let's go on to our next topic. We come to the Fed. So last week we had the Fed announce its interest rate policy. So while this was eagerly awaited, over the last 2 weeks, it was almost sort of a fait accompli that there would be an interest rate cut. And this kind of confidence only came in because of that huge revision in jobs data in the US, which showed that over the last 1 year, the kind of job added is far lower than what was reported earlier. Okay, we don't know what the reason is, what happened, what kind of glitches happened, but the data seem to say that number of jobs added is far lesser than expected and thought earlier. And so hence, in spite of inflation running way above the target, the Fed would give importance to this kind of a pain of job losses and cut interest rates. So the Fed's first duty is towards controlling inflation. Okay? But if you're seeing pain in the economy, they also have to act accordingly and help the economy recover. So while you did have job losses, economy was still doing pretty good. Paradox. How can you have job losses to such an extent that the Fed wants to cut interest rates, and at the same time you have an economy that is growing at a reasonable pace? And 40 and half much of the economic growth in the US is led by consumption. Okay, now here's a zapper. Statistics show that 49% of the consumption in the US was driven by just 10% of the population. 49% of consumption driven by just 10%, which reveals why all the job losses didn't have any impact. It was 10% of the people driving consumption. What kind of wealth inequality is that? It's just not US actually, though these data are not available for other places yet. Wealth inequality is there across the world. It is happening very much in India also. It is happening in many of the countries. And it is this wealth inequality that is eventually resulting in eruption of disturbances like what we saw in Nepal, what we saw in Bangladesh, what we saw in Sri Lanka, what we saw in Indonesia, and what we are going to see in many more places. All the eventually this kind of frustration and anger is also coming out in the kind of anti-immigration protests that are happening in different parts of the developed world. This has to erupt. There's no solution to reducing wealth inequality because capitalism allows the smarter guys to make more money. And if you didn't allow them to make more money, the smarter guys wouldn't be innovating. They wouldn't be creating businesses. They wouldn't be creating employment. But if you had capitalism with a heart, probably it could reduce some amount of wealth inequality. Okay, because we do see in many of these companies that the top bracket earn many multiples more than the bottom bracket. So this kind of gap could be reduced with lesser greed. Also, one reason why Japanese companies are healthier than American companies. American companies tend to pay out massive bonuses, pay heavily to the top executives, and also pay out large dividends, stock price buyouts to keep stock price healthy. So these things keep taking away reserves. Okay, while Japanese companies have been accumulating reserves, and in the process they have strengthened themselves way more than some of the American companies. Okay, so what has been the impact of the Fed rate cut? Then yes, so they cut 0.25%. Okay, and this was as expected. How did markets take it? Okay, so markets were looking forward. They sort of assumed 0.25% is happening, but what is the Fed governor going to say along with that 0.25% cut? Is he going to say there are going to be many more cuts, or this is it and we don't know, it's all going to be data dependent, don't expect more cuts? So what is the speak along with this is what markets look out for, and the markets were disappointed with what he spoke. He did not sort of endorse easy path to more cuts. He said we will be data dependent, and hence markets were not so happy. Initially they were happy, then later they were not so happy. So bond prices first rose up in the US, then they fell again because the path to further cuts is not evident. Markets in general rose up, then again fell. So they were all undecided. Central banks generally are not very clear about the future. They don't want to give a clear path. They want to shock the market always. Some kind of pleasure they get out of it. But I guess that is a culture of central banks across the world. I was just joking when they say they get a pleasure out of it, but they would like to retain the independence of taking calls and only giving guidance as and when required, and that is to control markets. Okay, and that is a power the central banks across the world hold across the, as far as the market. So what happened with Indian bonds? What happened with Indian currencies? What happened to the dollar? So the in anticipation of a much more dovish commentary, the dollar first fell. The dollar fell. Why did the dollar fall? The dollar fell because when you have lower interest rates in a currency, the currency becomes weaker. So if people thought that interest rates would fall in America, the dollar became weaker. But then towards the end of the week, it recovered some of its losses and sort of ended up in the same way as it began the week. Okay, marginally higher because there was no clarity on whether there will be many more interest rate cuts. Okay, so that was the dollar. American bonds first, the yields fell, then they regained and went back just to retraced much of their path. The same thing happened in the UK and in India too. Actually, far away from America, bond yields went up. Okay, so we may not know really whether this is because of the Fed rates policy or because of a higher supply of government bonds coming out in India. One can never say clearly, but it could be that it was a disappointment on Fed rate policy. Okay, so this is where it happens, and we know that a lot of why is the stock market still doing well in the US? Okay, they do think that a whole lot of investment happening in data centers in the US is going to be positive. The flip side of that is, while all the large listed companies in the US, the tech companies, have been heavily investing in data centers, which are very, very capital intensive, one needs to think what would be the return on investment on those data centers. Okay, there are many who think that ROI on these data centers is not going to be as great as they think. Okay, imagine cell towers, imagine power producers, capex heavy, but their ROI is never high. It's just going to be one more infrastructure. It's a necessary infrastructure for AI development, but it is not necessary that they return high. So we could see return on equity on some of these companies falling over time, not immediately evident, but falling over time. Okay, so that's where. Then let's come to that very interesting article on retirement. The headline says 50s are the new 40s. Why quitting isn't on their mind. Okay, so what does it mean? Unlike those in the 40s who, some of them who have been aggressive enough to retire early in the FIRE model, which was something of a fad. Okay, and the 50s are not as courageous about quitting because by then liabilities have really piled up. Okay, you have EMIs, home loans, you have children going to college, and job uncertainty. When is AI going to replace my job? When will my company want to reduce the cost structure and fire senior management and replace them by cheaper resources? All these are happening, very much can happen. So 50s are not really keen on retiring. They need to manage their liabilities and plan for their retirement. But some interesting takes from this, when the newspaper interviewed some of those in their 50s, okay, and there's a small box saying hits and misses. Let's see what kind of policies they had. save first and spend later. And many of them wish that they had implemented this idea, that they had saved first and spent later. It's always in the younger ages, one is eager to spend rather than save. Instant gratification, low maturity, and high confidence, high overconfidence, which makes them spend more. But we all know that saving early has such a huge compounding effect. It can reduce the stress of your later years. Okay, so that then financial discipline is what they think they wish they had. Most of them say that they would like to keep earning after retirement. I'm actually very happy to see this, because wanting to earn after retirement means you're going to be on your toes, continue learning, remain engaged with society. Okay, that is important for mental health and a longer life and a healthier life. So yes, and no lifestyle creep. So lifestyle creep is a huge danger. As you go through age and as you become more successful and earn more and more, your lifestyle keeps increasing. You spend more and more on lifestyle, and actually by the time you retire, you're at the peak of your lifestyle. And that means immediately after retirement, you are going to be spending max. You're not going to go back to a simple lifestyle, which is a danger. So you have to maintain a balanced view, and even as you earn more, you need to keep your lifestyle under control. And there's also somebody who says that he wished he had not invested so much in real estate as he did. He should have invested lesser. We know that real estate many times does not give you the kind of returns that it promises to do. We will maybe tackle this at a later time in depth. Okay. And then we have Dhirendra Kumar saying, should retail investors mimic career fund managers? So he says there's so much happening on social media and retail investors trying to create investment constructs like professional investors, looking at sector diversification, looking at non-correlation between investments, but they forget that they do not have the resources or skill that is available to a professional manager. They should rather leave the bulk of their investments to professional fund managers like mutual funds. Okay, I would just go one step beyond this, what Dhirendra Kumar says, and it's actually reflected in the next page of the newspaper, saying that reverse the exodus of India's retail investors. So there was a drop in the number of retail investors in India when markets came down. Okay, and it wants to reverse, because the more the number of retail investors, more the number of views on the market, and you should have divergent views in a market to give it activity and give adequate price discovery. Okay, but if you would combine the two and put my third view into it, I would say yes, retail investors are very important. They need to be present in the market, but it should be done in a limited manner. The bulk of the savings should be to professional managers, and if their interest is such, they should engage. They should learn about businesses. They should learn about companies and have more simpler models that they can understand and go for it in a limited manner to keep their mind active and alive. So it's been a long weekly wrap, but that's it for this week, folks. Have a great weekend. Good day.